Welcome to the Franchise Woman Podcast, where passion and purpose collide, profits are made, and relationships forged. I'm Rebecca Monet, CEO and Chief Scientist at Zorakle Profiles. I have a special guest today and a special co-host. Joining me as co-host today is Bruce McFarlane. Bruce is a lawyer, franchise lawyer specifically. He's also an investor and a franchisee, and he's down under in the big land of Australia. So thank you for joining us today, Bruce. Really appreciate it.
Thank you.
And of course, our special guest is actually a return guest, Alicia Miller. She joined us a couple weeks ago to talk about private equity. So Alicia Miller is the author of Big Money in Franchising, Scaling Your Enterprise in the Era of Private Equity, and is the founder and managing director of Emergent Growth Advisors. Emergent is a boutique strategic advisory firm with deep expertise in franchising and private capital, and particular focus on helping emerging brands grow smart from the beginning so they can reach their greatest potential. So our conversation was so intense and deep and meaningful that I'm so glad you agreed to coming back to another interview, Alicia. So welcome to the show.
Thanks. I'm happy to be here.
She says so humbly, right? So in our last conversation, you kind of set some framework for us, and you talked a little bit about how private equity is, becoming a dominant force within the world of franchising. And you also addressed the diverse range of private equity. But then you found a way to kind of simplify it, make it easy to understand by putting them into three kind of primary buckets and private equity franchise investment types. Can you recap just a little bit about the types of PE?
Sure. And the inspiration for doing it this way was actually talking to a founder who he was an emerging brand founder, and he wanted to attract capital so he could grow faster. And he flew to New York City and went on this quixotic quest to meet with every big investment bank and every big private equity firm that he could do, including some like Goldman Sachs and KKR. And my impression from talking to him was that it was a little bit like in the movie The Big Short, where the team can't get past the lobby and they're kind of sitting in the lobby with the JV team talking to them. And that's kind of what happened to him. And of course, the reason was he was targeting the wrong people. They were the wrong size. They were the wrong type of investor for where he was and his specific inflection point in his business, right? So I tried to take the complexity of all of these different players and different investing mandates and put it into three simple buckets: growth, value, and turnaround, both to describe what their mandate is and what they're comfortable investing in and what they want to pursue, and also to help founders in particular, and also franchisees in some ways, think about where their business is, so that they can, if they're thinking about bringing on an investor, make sure they're talking to the right people who actually have a mandate aligned with sort of where they are at that inflection point.
Yeah, otherwise it really is sort of throwing spaghetti against the ceiling, hoping it sticks. You really don't know who would be your best private equity partner if you don't fully understand their individual mandates.
Yeah, it wastes your time, and it also makes you look like you don't know what you're doing. So if you can think carefully about it up front and then be very targeted in who you're talking to and why, you'll just look more pulled together, which changes the game, right? You don't want to look like you don't know what you're doing when you start talking to these investors.
Which is why everybody needs to be buying this book, Big Money in Franchising. Author, our guest today, Alicia Miller. Bruce, what's private equity like in Australia right now? I know it's big here in the US, but how's it playing out in Australia?
I think Australia's a lot smaller market, so it hasn't really taken off to the same degree. And I think Alicia talks about, the different types of PE investors, and I think particularly in the Australian market, the people that are willing to invest into those really small, emerging franchisor brands is pretty limited. But I think if you look at the different types of PE, and I'm interested in Alicia's view about, the large funds that you mentioned there, like KKR, right down to like family offices and wealthy individuals. And like, I guess if you throw the net over all different types rather than just the big institutional funds, there are other opportunities. So, I think it's more in the Australian market, it's more a group of investors getting together and invest in those smaller ones. At the larger scale, if a business has already got, 5 million plus in EBIT, then it's of a reasonable scale. The institutions are more likely to have a look. But I think, Alicia, that's probably, I guess it depends on the types of investors as well as the types of companies. Is it like matching them together?
Yeah, exactly right. In many countries, private equity firms in those markets are backing operators, multi-unit operators, right? So they're taking well-established global franchise brands into new markets. So that's another wrinkle in the investment area.
Hmm.
So, it's funny when I read all the reviews of your book while I was waiting for it to be shipped to me. Um, so many addressed how you've taken a very complex topic and you've made it understandable to someone, especially franchisors or multi-unit franchisees that are looking for private equity. So I'm wondering if you could talk a little bit about private equity's playbook. I mean, what are they looking for when they're looking for a good investment?
Sure. So again, it depends on what type of investor we're talking about. So let's take a growth investor. Growth investors want growth. What they want is a proven model with a strong management team. And then they're going to invest in some very predictable accelerators, marketing, franchise development, support, possibly the tech stack, depending on how mature the business is. And they're going to try and get the thing to grow faster, bigger, stronger. And all of those things, in theory, should align well with what franchisees also want, because you can't grow if you don't have happy franchisees, especially those who want to come back and buy more territories. So the growth phase of PE investing and franchising tends to be the most impactful, where you see the most change happen in the brand and you see the most momentum of that brand and franchisees is in the growth phase. And all of those levers are very predictable. Once you get larger and you already have scale,
Can I ask just on that? So can we
Yeah.
just on the growth side, how big do they need to be? Like when you're talking about the size of the franchisor,
What's
can they
proven?
be, yeah, like what's proven? Because can they be 3 stores or, because some of them are quite small. Like, sorry, before we get into the value, but just into the growth, lots of those businesses, they don't really have a long time period with a proven track record.
Mm-hmm. Yeah, there's 2 buckets. So there's one group willing to back emerging brands. So they would call proven, 30 units, 20 units, as
Yeah.
few as 10. Recently, the sector's so picked over that they're starting to have to dip lower and
Yeah.
lower,
I've seen
smaller
that.
brands, right? So especially if they've got a platform, so then they've got some certainty that they could take these brands and bolt it into a platform where there's some synergies and they can share the team assets and so on. But growth investors that are bigger want more scale than that. They won't invest until you've got 100 units, 200 units or more. But they're still going to want to accelerate it past that point, right? So think of, in the book, I talk about Tropical Smoothie Cafe.
Mhm.
The first PE investors who came in got there when it had 315 units. So it was very proven at that stage, but still had work to do to optimize the model to make it really as profitable as possible for franchisees. And that's when PE came in and nurtured the brand. The first came in the emerging growth investors who tweaked the model and really improved it. They got it to, I don't know, 400 or 500 units, and then it traded again to a more scale growth investor, LLCP, and it kind of took it from there. And then now it's Blackstone owns it.
So in that growth phase, lots of businesses, they might be, I think we look at it under 50. So they've got less than 50. They're still, even if it's under 30, often they don't have the resources to have all of the things that you mentioned in place. So everybody would love to have more money when they've got that many stores. So it's interesting, that conversation, because the PE firms, the larger ones, if they're willing to entertain conversations with founders that haven't really established it, so they don't know what they don't know at that point.
Yeah. Yeah. Well, what I hope people will take from the book is the more you plan in advance and the more capital you bring to your emerging brand, the longer you can delay this private equity question, the better off you're probably going to be in terms of valuation in the short term. In the long term, it's very clear that accelerating these models, if you're partnering with somebody who's got a really strong track record, that second exit can be really, really lucrative for founders and for franchisees who kind of ride this thing alongside. But if you starve the business up front and you come in with only like bare bones capital to get the thing going, and then you spend all your money on attorneys and documentation to launch the franchise, no support, right?
Those attorneys.
Yeah, and then you go, so sorry, yeah. First. So then you go and sell a bunch of units, but you've got no way to support these franchisees.
Yeah.
And you've got 50 units sold, 25 open, no support, and now you're starving. And that's where all these guys end up talking earlier than they probably would have liked to private capital. And if they're lucky, they get picked up. And if not, they've got to live with what they've created and
they're probably making less money than they were when they were just running a small company-owned chain, because they've had to invest in all these resources. And the other one, sorry, just on this growth stage, is that founders often think they're going to take some money off the table at this first stage. And, the money's not all going to go into the business. Is that something that you find, or that their expectations, the founders' expectations are not aligned with the investors?
I have seen, well, I think that one of the things that PE looks for is, are they going to roll equity forward? If they really believe in the business, they'll want to roll potentially a lot of equity forward. Founders, I mean, it's fine to want to all of your eggs in this one basket. You've got all of your retirement in this thing, and they get it. You might want to take something off the table. But they don't tend to like people exiting, and they're skeptical if you're taking a lot out.
Yeah,
that's really interesting. We work with about 350 franchisors here at Zorakle. Many of them are in what we call stage 2, that 30 to 70 units. And the founder, the concept originator, has put his life savings and blood, sweat, and tears into the business. And he or she is just exhausted at some point and knows they have to get an infusion of some sort. So it sounds like what you're saying is, yes, a private equity firm might actually take advantage of that, or better yet, let's learn how to position ourselves where we take our equity later instead of upfront. Otherwise, you're going to be giving away your wonderful idea way too soon and walking away with a whole lot less than what you really deserve.
Yeah, well, and worse, there are some investors who will tie you to an earnout. So now, not only have you given some equity away, cheaper probably than you'd like to, but now you've got a contract that you've got to deliver. Now you're an employee again. You'd be better off if you really believed in your business case, and if you really believed all those units could get open, and if you brought enough capital in the first place, get more of them open, then now you've got something that's really much more compelling. It's the starvation phase that we see so many brands fall into that we need to try to pull ourselves out of a little bit. And look, the private equity firms, most of them are not looking for those bargain opportunities. They want proof. They've only got a few years to deliver on their mandate. Yeah. So they'd much rather see a stronger business and write a bigger check.
And those businesses at stage 1 or stage 2, I think one of the key things is the founder understanding their competencies and their character, what they're good at and what they're not so good at, and being very self-aware of their skill set. And also then thinking it's not just about the money, and the money brings the resources, but also what's the expertise or the skills that they can bring to the business. And I think that's a challenge for the founders to really be self-aware enough to understand, what do I really need to bring this business? Am I getting in the way of the business by trying to control too many of the big decisions? Is that something that you've seen as well around that emerging franchisors?
Oh, yeah, for sure. I mean, look, we've all got the ceiling above which we have to stretch to really grow and do different things. We know how to get to point A. It's getting to the next point can be harder. Good management teams have great relationships with their franchisees, really understand how to hone the model, but they've also got to be coachable and open to feedback, because you're going to bring in these strategic thought advisors and new owners into the business if you're bringing in PE, and they're going to have some new ideas, ways to think about the business you might not have thought about before. So you've got to be open to that. But they're looking also for you to have a vision of the business and a perspective on the business that they don't have, because they're not the operators. So if ideally you're both bringing something different to the table that will mesh well, and that's when you've really got to interview the more human side of this. This is more Rebecca's area. Is this going to be,
Now we're talking, Rebecca.
is this going to be a good match or not? I don't know. You're getting
Yeah.
married to these investors, and you've got to be able to work well together.
Yeah. That's such an excellent point, because technically they become your partners.
Well,
And
they're really your boss. They're the
your
majority
boss.
stakeholders. Yeah. Let's not sugarcoat it. They're calling the shots.
And entrepreneurs often don't like a boss, because that's why they start their business.
That's why they were
It's gotta be
entrepreneurs to
worth
start
it to
with.
you. This trade-off has to be worth it. It could, if it accelerates your business and takes you in a better direction, it might be worth it to you, but you've got to think about that before you pull the trigger, and just make sure.
Yeah. I'm aware of a franchisor that's gotten quite big now, but was very small when they came on board with us. And a similar thing, they brought in an investor, and all of a sudden there was nothing but this and this and this. Two very young men building a beautiful business with a vision, but the vision didn't completely line up with the investor. And it took a lot to get out of that situation, where it ended up being a win-win. But during that time, they struggled, for 2 or 3 years trying to work with someone that they really weren't compatible with, and probably vice versa, right?
It's kind of like Discovery Day. A friend of mine, CEO of a large child education franchise, used to say in Discovery Day, if you don't like us now, you're not going to like us ever, because we're on our best behavior today. And so if this doesn't feel like a fit, then you should say so, and we'll part friends, and it's fine. But through the same process of getting to know a private equity firm, everyone's on their best behavior. Everyone's thinking about the deal, and there's a big number involved and so on. But you have got to take the time to check references and talk to other people they've worked with and find out what happens when there's a disagreement. How have you how have you handled change? What if there's, something happens with the franchisee? How do you handle those situations? And ask some really good questions, because once you've signed the deal, then it's hard to go backwards.
Yeah, you can't get infatuated, I guess. Like you said, it is that initial stage is a dating and an infatuation stage with one another. So you do need to take time. From your estimation, what is a good time frame when you're first considering to when you're ready to do something like this, to truly get to know one another?
So I would back up even further than that. I
Okay.
would say every business owner should be thinking of the exit from the beginning, whether you're a franchise or not a franchisee or franchisor. If you're not thinking of the exit, you're not being realistic, because at some point you're going to leave this planet, and you've got to have a path for what's going to happen with this business of yours, right? So that's number one. If you have a plan in place where you're thinking, okay, 2 or 3 years from now, I might be ready to take on a private capital partner, that's actually a pretty good time to start at least making some lists and thinking through the type of investor that's probably going to be the best fit. The book kind of helps you work through some checklists to help figure that out. That's the basis of my consulting practice, right? Help people figure out who the likely investors are going to be, and then start doing some, curated networking with those specific groups. Get to know them a little bit without the pressure of any sort of transaction hanging over you. Get some feedback, figure out what they're like, talk to other people who've worked with them, Start paying attention to what deals are getting done and why, and what's happening with all these different platforms. If you do that a couple years in advance, you'll be much better prepared. If you wait until 2 months before you hire a banker, that's just too fast. You're by then you're more focused on getting all your ducks in a row for the actual transaction, which is a lot of work in itself. But you've got to think about what your objectives are, likely partners, what you're looking for in a partner well in advance.
It's interesting what you say around thinking of the exit at the start. I talk to a lot of the clients that we have about that, and there's three scenarios where there's an exit. There's one where you choose it and you go on, you set a plan and you go on it. But there's one where a competitor or someone taps you on the shoulder and says, "We want to buy your business." And if you're not prepared, you give away too much, and it's not a great result. And the other one is where you've run out of resources and you've run out of cash, and someone tells you you've got to do it, which is the bank or someone or your landlords or anything like that. So often only one of the three paths is actually at your design. So getting ready for that. But yeah, it is interesting that they wait, and probably that third one where someone's telling them they need some more money because they haven't got enough. They're desperate. It's like they're in a dating game. they're too keen, and they're too, because they haven't been planned. They haven't planned enough, so they need the money now, and the investors know that, so they get scared away from it.
Mm-hmm.
Well, and so many franchise founders, they end up there almost accidentally. They're running a great business, a great restaurant or whatever, and one day a client says, "Is this a franchise? Have you thought about franchising?" Or they get a call from a broker who says, "Is this a franchise?" And then, one thing leads to another, and now they're a franchise. Well, now they're learning how to be a franchisor, which is totally different than the business they started with. So now they're learning that and learning franchise best practices, and they're ramping up and learning that game. And then the business gets some momentum, and all of a sudden they start getting phone calls from these private equity firms. And they're like, "Well, what is this? This is new. Now what do I do?" Right? So now they're having these conversations. They're totally unprepared. They haven't really looked at the landscape. They haven't had any real exposure to this. And they start having, it's very flattering to be called by, some search firm who says they're doing a search for so-and-so. But it's really not the way to go. You've got to, that's part of why I wrote the book. I'm hoping that people will take a more thoughtful approach, and they will have a better outcome if they just educate themselves ahead of time and think through the different options ahead of time, and hopefully preserve their optionality as much as possible for as long as they can before they pull that trigger.
Amen. Amen. Having the exit in mind, having possible future buyers already in mind, spending some time getting to know them, whether it's through networking or panel discussions or whatever, and how they operate. So we're all in similar circles, but if we're deliberately putting ourselves, as you put it, I think is absolutely brilliant. So okay, I started a franchise. My exit in mind is at some point I want to get private equity involved and slowly begin to exit. In between that time, as a franchisor, what am I focusing on? Is it revenue? Is it number of units? Is it infrastructure? Is it technology? What am I focusing on? So I am a pretty franchisor when a private equity firm begins to look at us.
What does pretty look like? Pretty looks like a strong management team. Pretty is profitable, satisfied franchisees. So they need to be, depends on, if it's a part-time franchise versus a full-time brick and mortar, there's a range of financial outcomes that are appropriate depending on what the initial investment is that people are making. But franchisees need to be taking home 15 to 20% profit at the end of the day after they've reached their initial break even, because otherwise you should just take your money and put it in the stock market, for goodness sake. Right? I mean, this is not passive income. This is work, and you're making an investment, and you're taking a risk, and your retirement may be at stake. You might be signing a personal guarantee. So most PE firms like to see payback for franchisees' initial investment faster than 18 months. The faster, the better. There's some wiggle room if it's a much larger investment, such as like a large family entertainment park or a big swimming pool, sort of a build out, or a daycare center. Okay, maybe that slides closer to 2 years, but generally 18 months or better is good. And for a business that's like a remote truck roll kind of a business, that should be even faster. They should, the franchisee should be able to run this and through a manager, ideally. So there are a lot of models that tend to prefer owner operators, but if there's not enough headroom financially in the model to hire managers to do at least some of the work, then franchisees can get burnt out. So most investors prefer to see a model where it can be run through managers, because that's when you start to get scale, right? So now you don't have to recruit 1,000 individual owner operators. Now you can recruit several hundred multi-unit franchisees and end up at the same place. And it's much more manageable at the franchisor level to do that. So initially,
So if you don't have multi-unit as part of your, if it is an owner-operator model, even if you've got 200 or 300 of them, it may not look as attractive as if you have 50 franchisees with 3 units each.
Well, it depends. How healthy are the franchisees? We've got a whole crowd of franchisors now who are signing multi-unit deals to first-time franchisees who've never run a business before.
Yeah.
So investors will wait and see how that works out. They'll want to make sure that those actually get open, because otherwise they're not going to pay for a funnel that's not real. They're not fools. So if that funnel looks fictional or looks risky, either they'll want to wait and see if it gets open, or that won't be part of the deal if you do a transaction. It'll be discounted somehow, or there'll be an earnout attached to it. So there's nothing wrong with an owner operator model. There's nothing wrong with a multi-unit operator. It's got to be right for that business, and it's got to be thoughtful recruiting about who the ideal franchisee is to be successful.
And yet the emphasis is, if it's an owner operator model, that a manager should be able to run it, that franchisee should be able to step out and not burn out, right? That makes it more attractive to our investors.
Well, it also makes it more attractive for the franchisee, right? At some point, that's an asset that they want to sell. If the thing only works because that franchisee is in it every single day, that's a hard asset to sell. Then your only buyer is another franchisee who's willing to do the same thing. That's a very much smaller buyer pool than if you can run it through managers. Now you've opened up to consolidators. That gives you many more options, including professional investors potentially coming in.
Okay, now that you opened the topic, what is a consolidator?
And someone who's buying a bunch of units and running them as a multi-unit form.
So it's a true management group that will buy multi-units and then just run it that way. And we're seeing more of those, by the way, Alicia, on our end. True, rock stars that go, okay, we got these 16 units going, I'll buy them all, but they're already up and going concerns, are not starting organically. So there's some great advantage to consolidators if those individual businesses can have a manager step in and run it. So I love it. I am wondering, unless Bruce has another more technical question, as a behavioral scientist, I'm wondering about the psychological component. Bruce, is it okay for us to shift, or do you have additional questions more on the technical side for Alicia?
No, I'm happy, because it's understanding the behaviors of the different parties.
Yeah, I agree. So this is a big decision for a franchisor. This is something they, better widget they created, or a better process, or it's their baby and they've nurtured it and put their money and sweat and tears and into this. Talk about the psychological piece of beginning to let go and being okay that you now have technically a boss.
So there's a couple of inflection points here to think through and chew on if you're a founder. The first time you bring in outside capital, you've got to be very clear on your objectives and your reasons for doing so, which will then help you pick correctly so that you've got the right match, right? So you're probably bringing somebody in because you want to accelerate the business. You've taken it as far as you feel you can at this point. You want to take some few chips off the table. You want to de-risk things for yourself personally. Those are all super valid. Now you're trying to find a great partner who's going to work probably alongside you for some other period of time until they're ready to exit. So that's a fairly common path, right? So that transition point is about being self-aware enough to recognize when you might need the help and being very clear on what help you need and then open to it. And then getting over the hurdle of, okay, now you do have a boss. No matter how collaborative they are, it does change the temperature of the water, right? You're now, that's when you've got to talk and get references ahead of time about who's really making this decision here. If there's a disagreement in approach, who makes the final call? Do they trust the founder still, even after they've invested in the business to make that call? Or is the tiebreaker the PE firm? Good to know in advance. And then you can decide what's right for you in that circumstance. So you've got to be sort of ready to make that change and have that partner. If you pick well, you will have a partner who works alongside you, makes you better, stronger, faster, smarter, asks questions maybe you hadn't thought to ask or asks them differently, is willing to back you might have big aspirations of things you want to do. For example, go out and acquire more businesses to add to a platform or, build out a tech stack or something. And now you've got the capital to do it. So there are benefits there, but you've got to be emotionally ready to let go a little bit. But choose wisely so that you find a partner that fits your style and what kind of input you're actually asking for. Then in the next transaction is when it can get interesting, right? So by the second transaction, that PE firm is now exiting, usually in about 5 or 6 years, and another investor is coming in. And you, as the founder, may not have a say on who that buyer is. That changes the dynamic yet again. And it might be a very smart thing to do to bring in that next firm who has skills to take the business to a different level than the first investor maybe, was good at. So it can still be great for the business, but now you're even farther removed potentially from the decisions, and the culture is going to change as well. So that's when it starts. At that point, a lot of founders will have done really well in a second transaction and maybe looking to retire at that point. So that's a cultural shift in the franchise that in many ways is harder on franchisees than on the founder, but it's still hard to watch your baby, even though you got a big check, it's still your baby. In the book, I interviewed, I had the privilege of interviewing Dina Tripp, who is one of the co-founders of Nothing But Cakes. Lovely person and an amazing entrepreneur. And for her, it was very clear that the hardest transition was the second one when she exited, because she was really letting go. And that feeling of letting it go and it's going to have to thrive, without me at the helm was hard. Understandable.
I miss her. I miss Deb. Yeah, I want to validate what you said, Alicia, because when private equity comes in that first time, not only does it escalate things and the accelerate is the word that you use, which is probably a better word. It does begin to not just change the system, but it changes the culture. By the second time, the culture will have a dramatic change. And not only will the founder maybe not fit in that next one, but our franchisees may not gracefully go through that. They liked when the founder was at the helm, and they liked the more friendly, collaborative, kumbaya culture where they may not have that going forward. So there's a lot of changes that happen, and those are all things that the franchisor needs to ponder and think about if they're capable of going through, and can their franchisees come through it too.
It's kind of like, when people decide whether or not they want to take their business public, there's you're used to doing things your way without the level of scrutiny, and suddenly now you can't just hire that person that you wanted to hire. You can't just spend that money. You've got a board of directors and you've got investors. So for franchisees, I mean, look, every business has to change. This is a very dynamic, competitive market. So I'm hoping that franchisees read the book and think to themselves, okay, if this is a good business, chances are pretty high this thing is going to trade eventually to private equity, or if it's already owned, it'll trade again. And then I just need to be aware of that and choose a path that's good for me, because some of the changes I might like and some I might not like. But you got to keep your business in a state of readiness to sell, so that if you don't, for whatever reason, like the direction, you're able to move on and do other things.
And I just thinking about those two, the first and the second transaction, is some of the founders look at whether or not they can bring in investment but maintain the majority. So I think thinking about that, having a boss and the mindset of the founder, there are investors out there that will take a minority stake, and then the documentation does allow for the founder to actually have input into key decisions like, the original private equity firm's exit, who it's going to be. Is that just not very common, that normally the private equity want the majority in the first transaction?
Yes. Yeah. And that's just because their mandate, they have a fiduciary duty to the pension funds and university endowments. They need control in most cases. Our investors, for sure, that have the ability through their structure to make minority investments, but you need to hire yourself a good M&A attorney who understands the language in that contract, because just because they're a minority investor does not mean they can't exert some effective control over things. So just get counsel's help and eyes on that contract.
Which is often not the same attorney that was your franchising lawyer.
No, that's a franchise lawyer. Probably not. Yeah.
And that's coming from a franchise lawyer. So listen to that advice. Yeah. Oh my goodness. So I don't want to give away the whole book because it is so insightful, informative, and ultimately understandable, right? Something that was very complex. So I'm going to shift the conversation just a little bit with your permission and ask you, if I was a franchisor and I'm pondering this idea, what questions should I be asking myself and or a private equity firm to really get an idea that this is right for me?
Sure. Actually, in the book, I think it's might be chapter 18. There's literally a checklist for that. So that hopefully will help people. Franchisors, again, have to sort of align around what are you trying to accomplish, and think about the life cycle of the business and how much longer you want to be in it, how active you want to be, where you want to take it, what you want out of a transaction. You've got to get help if you need to think it through, and ask people who know you well. Come up with your list of what you think your answers are and bounce it off people who know you really well, and just make sure you're not creating fiction in your own mind about what's really going to work for you. I think your closest friends and associates and advisors can help you figure that out. When you're getting to know private equity firms, for me, track record is incredibly important, as are founder references. Find out what they're like to work with. It's really no more complicated for me than that. The complexity is in teasing out the answers and pressure testing your assumptions. It's very easy to get infatuated and to get caught up in the deal process. Think back to how many people recruit franchisees into their system. It is possible to rush through a sales process, not really think about whether this is a good match, because everything feels kind of good, you like each other, and so on. You want to keep your mind on, time and kill deals. So you don't want to drag your feet unnecessarily. I have seen deals fall apart because founders got a little greedy and wanted to try to get more units open before they closed the deal because they wanted to get paid on those. That's a mistake. Don't do that. But make the time up front to really get to know these folks. That's why I advise people to try and do it before you even start a transaction. Start narrowing the list down and get to know the landscape a little bit before you even open yourself to that.
Maybe we
Yeah,
need
because I
to
think
have a club where we all get together and, have cocktail hour by Zoom or something and have these open conversations.
oh, for sure. There's lots of groups. I think as a franchisor, part of those groups, that through the IFA or that where you talk about this sort of thing. Because the other thing that happens, I think, Alicia, is founders when they're going through this process get quite distracted from their business. So if they take their eyes on the discussions with the private equity firms, and particularly if they're running multiple discussions at the same time to create a little bit of competitive tension between the private equity firms. They're dating multiple people. They've got things happening, but no one's actually keeping an eye on the business.
Yep.
We find that can be quite distracting because you say time kills deals. So this can take 6 to 12 months where they're actually over here running around, flying to New York and flying to LA and doing their thing. And over here, the franchisees have already lost the person they want to talk to, and the management team they don't have because the founders got very excited and he's running around. So is that some advice around that about actually the founders managing the process?
Mm-hmm.
So it's very distracting. That's why I advise people to start early. And for example, just getting the data room pulled together can be a real slog for some firms. Depends on how many folks are, if you're well staffed, hopefully it isn't so much effort, but there's a lot of things you can gather well ahead of time without pressure and get that stuff done early. And then just make sure your team is updating it on a regular basis. Then it doesn't become such a distraction, because as soon as you start that conversation, they'll be like, all right, send me your last 5-year P&L. I want to see your cohort analysis. I want to see by tenure, all your franchisee performance. Oh, I want to make sure you've got all your receipts done, et cetera, et cetera. And there's this long list of, 10 or 20 things. And it's the same list from almost every PE firm or strategic buyer. So why not just get it done in the first place? Do it early. So you've got it ready to go. Keep it updated. Do the dating a little bit, get to know people ahead of time. And then that way you're not complete strangers when you start that conversation. It's nearly impossible to really assess who that buyer really is in the heat of an auction process. It's just hard.
Mm-hmm.
So the more you can do that ahead, really the better.
Yeah. So let's talk about the future. You saw a gap here, which is why you went to this extensive amount of research and case studies and interviews to provide us a resource. And then, of course, your consulting services that helps folks through this. Talk to us about the future. What's going to happen with private equity? Is it going to continue to get bigger and bigger? I mean, talk to me about that.
Sure. So there are some very clear trends. So I'll make some predictions here. A lot of businesses have been already purchased by private equity. More than 700 brands have received investment. And if they were bought between, say, 2014 and the pandemic, all of those need to probably retrade unless they're owned specifically by a long hold investor. So we're going to see, especially as interest rates hopefully come down a little bit, we're going to see there's a whole bunch of stuff that needs to trade just to get so that the existing investors can get some liquidity back to their investors,
Mm-hmm.
right? So they've got to return that money. So we're going to see a bunch of those deals start to trade. And meanwhile, there's capital that others have to deploy. So there's a whole lot of appetite there that's a little pent up right now, backlog, whatever you want to call it. So we will see a pretty active environment, I think, once we get through the election, especially, and into next year. I think it's going to be very busy. We're going to see more PE come in. Franchising's attractive, right? So there's more and more interest in the area. We're going to see more PE firms tempted to acquire businesses that are smaller because so many of the others have already been picked over. We'll continue to see a lot of new entrants, new firms launching their franchise because of all this PE activity. Hopefully they'll be smart about it and thoughtful and not rush to sell a huge sold not open funnel that then attempt to trade quickly to private equity. Because I think if enough of that happens and it turns out to not be real, we only need a couple of high profile implosions and that'll shut down. So I think we've already seen some pretty frothy valuations in 2021, and everyone's got to live up to those business cases now. So another prediction is, I don't think there's ever been a better time to be a great operator. If you're on the corporate side, there's so much talent, need for talent in these PE-backed brands where they've got a mandate to grow and they need great operating talent. So they backed a good management team, hopefully, but if they need to make a change, they're not going to wait. And they need to expand the team, they're not going to wait. So it's you'll see, if you watch LinkedIn at all, you see a lot of people moving around right now.
Yeah.
Just a lot of really great opportunities.
A lot of people moving around, and some people just filling a gap for a period of time as interim this and interim that till they find the right. But you're right, these roles we're going to have a higher need for here very quickly, and we're already starting to see it in staffing companies that are starting to address that too. So
I think one last trend to mention is franchisee associations, I think, are now seeing the need to step up earlier, be more vocal, and to make themselves an entity of consideration when these transactions happen. It doesn't mean they can stop an investment from happening, but I think they've figured out that they have got to be more vocal.
they got to be heard.
As these things happen and make themselves an entity to be contended with, because not every decision that's made is something franchisees like, but the time to create influence and to create that mechanism to manage through change and to manage through differences of opinion is not in the heat of an argument.
No.
You've got to set it up while everyone still likes each other and gets along. And then you can get practice at doing that well. And that creates nice continuity through multiple changes in ownership and the business needs to change. So you've got to figure it out. But the time to set up an association and figure that out is not once things have already started to fall apart. You got to do it up front.
No. I want to make sure we give people an opportunity to reach out to you. What's the best way for someone that's interested in your consulting services, wants a copy of the book, wants to just connect with you? How would they do that?
Sure. The book's on Amazon, so it's pretty easy to find. Big Money in Franchising. To reach out to me, you can go to bigmoneyinfranchising.com, and there's a form you can fill out to get to me, or emergentgrowthadvisors.com, or find me on LinkedIn, Alicia Miller at emergentgrowthadvisors.com.
Perfect. Bruce, do you have any final questions for Miss Alicia?
I know we're the trends you were just talking about. One of the trends that I'm seeing is around US brands looking broader than the US market, and saying, well, look, there's a lot of, whether it be Asia or whether it be Europe or to grow their brands, because obviously there's only so many units you can open in the US. And so to really expand, they're saying, well, is this something that we can scale not only domestically but internationally? Is that something that is a part of the mindset of the PE and a trend you're seeing as well?
Yes and no. I think the PE firms that are really adept at taking US brands into international markets is a subset of the total, right? And second is that is a real champagne problem. When you've sold so many units in the US that you've run out of runway and now you've got to go into other markets, think about it. That's like 5% of all of the brands have that problem. So yeah. I think more commonly what I see is brands from other markets who want to come into the US because it is such a big market. And what they don't understand about how private equity has really changed the competitive landscape, especially around recruiting franchisees. And that's where they've got to invest their time to understand it well, because it's not just because you've got a great concept in Australia or New Zealand, it doesn't automatically transfer to here. You've got to really get some help to launch well and get the visibility, because it's noisy and crowded, and you've got all these PE-backed platforms, outsourced sales organizations and broker networks that have just tremendous influence over which franchises get sold. And you've got to navigate that well.
Oh my gosh, guys, we could talk about this topic for 3 days straight and not run out of the knowledge that you have, Alicia. Again, thank you for joining us today and being so generous with your advice. Guys, if you haven't read this book, you've got to read it. Some of the case studies are really fascinating, so you get a real life experience of how private equity has changed the landscape of franchising and will continue to do so in the future. So thanks again, Alicia, for joining us today.
Thank you.
And Bruce, thank you for being my co-host today. I appreciate you.
Thank you for having me.
And to those listening in to the Franchise Woman podcast today, share, like, comment, but most importantly, of course, see us again next week on another show.